After this week, we're going to get 2 more CPI prints before that September meeting. So the August pause builds in an opportunity for them to stay flexible. I think what happened today was, we didn't see the futures market move too much on what it was expecting in July or September. But I think if we get a cooler print on CPI this week, and if we get a cooler print on PPI, September will get priced in as a lock.
Okay. So what does that mean for me preparing for that as an investor? What do I do?
Well, I still think there's a contradiction. It seems like the market continues to cheer cooler data as long as earnings are strong. And that's okay. But as soon as we start cheering cooler data that sometime will catch up with earnings, I think the market's going to have to digest at what point is cool too cool.
Well, that's what Goldman was talking about today, right? I don't know if you saw that blurb from them. The idea that bad news is eventually going to be bad news for the market. Well, at least it could be.
Well, and there's been sort of this detachment. We want the economic data to get cooler, but earnings data needs to stay strong.
There you go. We're showing it on the screen right now.
And it continues to be that way. And I think this quarter probably continues to be that way as well. Where we get cooler data in the economy, it confirms that the Fed can start cutting rates in September, and stocks will cheer that. But some of the things that I look at that are a little bit concerning about it is that even if we compare it to the mid-90s and say, okay, the Fed started cutting rates, everything was fine, we secured a soft landing. They started cutting rates at a point when the unemployment rate was 5.6% and falling. So they cut rates at that point into a strengthening labor market. At this point, we just crossed above 4% in unemployment. We've gone up for the last 3 months in a row. It will likely continue to weaken. None of these numbers are concerning, but it will likely continue to weaken, and then the Fed will be cutting into a weakening labor market.
Sure,
which the market has to understand.
Yes, okay, but weakening from a high level.
From a tight spot.
So that's what the Fed chair said today, right? Yes, the labor market's cooled, but it's still strong, right? He used the word strong. It's back in balance, is the labor market. It's not like it's falling apart.
Correct.
It's just slowing.
Right. And his
Which is kind of what they need.
Yes, right now.
In some respects.
In this present moment right now, that is exactly what they need. And being back in balance is referencing more how many jobs are open versus how many people are unemployed in order to fill those jobs. We were way too tight before, driving wage costs up, and we all know that that put pressure on earnings in companies. The issue is that if you look over history, the longest history you can find of an unemployment rate, as it starts to rise, it hits escape velocity quickly, and it's difficult to stop that rise. The rises usually happen very fast. So right now, we're still in a good sweet spot. Between 4 and 4.5%, I would call the sweet spot of the unemployment rate, because 4.5% is still what's considered frictional unemployment, what we can expect even in a healthy economy. So that's okay. What we need to not happen is that the speed picks up. If the speed picks up and we can't get a hold of it while the Fed is cutting rates, then it'll look like they're reacting to something that's getting weaker.
Okay, so maybe the most debatable idea you have that we can kick back and forth is this idea of a portfolio move to make right now. Trim some gains, particularly in large caps that are driving the market. You're talking about mega caps, okay? And allocate to sectors that benefit from steepening yield curve. We can go through what those are, but you really want to take some profits off the table. I know you're smiling because it's like a gutsy call, right? I mean, some people are going to say, no way. Why do you want to do it?
So whenever the market gets to extremes, it's at a higher risk of what I'll call normalization. I'm not even going to say mean reversion. I'll say normalization. Some of the metrics that are getting uncomfortably extreme right now are things like the forward PE ratio on the S&P is in the 89th percentile. The spread between the market cap weighted S&P and the equal weighted S&P over 1 year is 17%. That's in the 99th percentile. And then we've got the max drawdown this year so far, only 5%. If we hold that, that's in the 91st percentile. So we are getting to the point of extremes, just in the sense of, okay, is it time for there to be what I would call a redistribution of strength? Okay, that doesn't mean that we have to have this big pullback, but when you get certain pockets of the market that are so overly valued compared to others, there might need to be a redistribution. Some people might call that a broadening.
Okay, well, that's what I'm going with, though, because can you get the broadening? Do you think there's going to be I'll use your words, the redistribution of strength at the same time where you appear to have some growing concerns about the strength of the economy? So Do I want to buy into your broadening story at the same time I buy into your weakening story? How do I do that?
So, good question. The broadening story that we've seen so many times has been a broadening into cyclicals, a broadening into small caps. What I would consider a broadening now is a broadening into those sectors that would do well, that tend to do well in a steepening yield curve environment, which is what I expect to happen in the second half if and when the Fed starts cutting rates. We'll see the two-year come down. Some of it is financials. As the yield curve steepens, yes, financials should benefit from that. But the ones that tend to do well in a prolonged steepening environment are things like energy, stocks that are paying a good dividend, and then staples, utilities, healthcare. I'll put a little asterisk by healthcare because of the election, but those are the sectors that tend to do well. And that's not even a defensive statement. That's more of a dividend statement, and the ones that are not the high flyers that have benefited from what we've seen in rallies recently.